Hey traders, Gavin McMaster here from Options Trading IQ, and today we're going to be looking at how to adjust iron condors. Before we do, just a quick reminder that everything discussed is for educational purposes only, is general in nature, and does not take into account your personal circumstances. So here we're looking at an iron condor on Goldman Sachs that has become a little bit skewed with more risk on the upside. So when we started the trade, Goldman Sachs was about here, 490 or so, right in the middle of the condor. Our deltas were nice and even. Since entering the trade, Goldman has moved up, and we're now getting closer to this short call. And my decision point went off on Friday, which was the stock price of about 510. We closed just below that at the end of the day, but getting to a point here where I need to think about making an adjustment. One little rule I have with iron condors is I look at this purple line, which is our T+0 line, and I think of this as a hill, and I always want to be standing on top of the hill. Let's say there's a ball on top of the hill here. If we're at the top of the hill, it's fine. If the ball starts to roll down the hill a little bit, once we get to about here, it starts to pick up speed and the ball starts to roll down the hill a lot quicker, and those losses start to get bigger and bigger really, really quickly. So that's why I have a decision point here before we get close to that short strike. Usually that's around a delta 25. At the moment, we're a delta 21. But as the price alert has gone off, I'm going to look at adjusting this one. When it comes to adjusting, I classify them as either defensive adjustments or attacking adjustments. So if we were going to play defense, we might close this call spread 530, 535, and we might roll it out to 535, 540 or 540, 545. So let's take a look at how that looks. So we'll go to our option strikes and we'll say we're going to roll it out to 535, 540. So basically what we would do is we would buy to close this spread and then we would sell to open this spread. So it becomes -2 here, +2 there. So you can see we've moved our strikes further away. Our delta's got a bit less. We're back to around a 15 delta, which is pretty good. We're still not really on top of the hill though, are we? We've still got a little bit of danger here that our ball might roll down the hill a little bit quicker. Now, if we look at the cash flow from making this adjustment, basically we're buying back this spread. So that's going to be negative cash flow. We've got 200 contracts. It's going to cost us about $200, $205 to buy back that spread. And then when we sell 2 of this spread, we're going to receive money. It's going to be a credit. And we'll just say roughly those prices will get a credit of about 147, 145. If we add the 2 together, it's going to be roughly a net debit of about $55 to make this adjustment. So we've moved our strikes further away. We've given ourselves a bit more margin for error. The price is, it's cost us money to make that adjustment. We've reduced our profit potential in order to have a bigger margin for error. Now, the other style of adjustment, which I would consider in this situation, given that the delta of that short strike hasn't yet hit 25, I could potentially leave these strikes alone and instead do an attacking adjustment, which would be to close the untested side and roll them closer in. So that's going to produce a credit, still going to reduce our delta, but we're actually going to receive some extra premium. It's going to increase our profit potential. So let's add some roughly 15 delta put spread. So our 15 delta, we'll say 16 is at 480, 5 points wide, 475. So what we're going to do in this scenario, and just watch the expiration payoff line. At the moment, it's sitting just below 250, probably around 240 in premium remaining in the trade. We buy to close this one, and then we sell this spread. And you can see that's generated a fair bit of extra premium. We're now up around $330 in premium remaining. And if we just run through the numbers in our spreadsheet, we're buying the lower spread to close that one. So that's going to cost us about $35. And then we're receiving a credit for selling this spread of about $130. And we sum the 2 together, that adjustment is going to be a net credit. So in this case, we're actually receiving close to $100, and we've actually reduced our delta even more, and we're getting closer to being on top of the hill here. So for me in this scenario, I would probably prefer this adjustment, rolling the untested side in, which I would call an attacking adjustment, rather than rolling the calls out, which would be a defensive adjustment. So two benefits to the attacking adjustment. We receive a credit for doing it, and we're actually getting closer to delta neutral as well. The trade-off, of course, is we've now got a much narrower condor, and there's less margin for error on the downside if Goldman does reverse. But overall, I think the attacking adjustment looks better. So hope that helps you. If you've got any questions, just let me know, and have a great day.